Hello, and welcome to the Joe DeLisi Financial Advisor podcast. Today, we are discussing presidential election and the markets. This is part three. We're revisiting this topic that really stirs a lot of anxiety among investors, the presidential election years. Now, we covered this in podcast number 4 way back in February 5th this year. So if you want to go back and listen to that one, that will actually help provide a little more context to what we're going to go through today. But, with the recent turmoil due to President Biden's debate performance, his apparent health issues, and then his, leaving the presidential election, there's just a lot of uncertainty. His party is currently debating who's going to take over. At the time of this recording, we don't know who that is yet. Looks like it may very well be Vice President Kamala Harris. And this just feels different, but aren't they all? And so we talked about this last week. Usually I try to come out with a new podcast every 2 weeks, but with the fast-moving news, I'm trying to get things out a little bit more frequently just to give you a little bit more data. Now, historically, any presidential election can bring uncertainty and volatility to the market. But there are ways to navigate this turbulence successfully. So let's dive into historical data to alleviate some of your concerns and provide some strategies for maintaining a steady investment course during these times, even when it obviously feels different. And again, it's heavy with data, but it has to be because math has to dictate where we go. It can't be emotions. Emotions will not lead us in a safe place in the stock market, really ever. So let's revisit the historical performance of the stock market during presidential election years. And while it's true that markets can experience heightened volatility due to the uncertainty of potential policy changes, the overall trend has been relatively positive. So according to data from the S&P 500, again, it's a proxy. It's not the entire market is a market, but for brevity's sake, we're going to use this one market with this one index. So since 1928, the average return in presidential election years has been about 7.1%. Now, this is slightly lower than the average annual return of 8.5%, but still a solid performance considering political uncertainty. So let's now break down the performance by party outcomes. This is where it gets really interesting. So if you're driving, perk up and pay attention. So interestingly, the market tends to react more to the anticipation of change rather than the actual party that wins. So for instance, during the election year of 2016, when Donald Trump won, the S&P 500 returned 9.5%. Similarly, in 2008, when Barack Obama was elected, the market saw a decline of 37% due to the financial crisis mostly, but this was more tied, again, to economic conditions than the election itself. Another point to consider is the so-called election cycle theory, which suggests that the stock market tends to perform differently depending on the year of the presidential term. So historically, the pre-election year tends to be the strongest, with an average return of 16%. Very, very high. That's above the norm. That's above the average, right? So it's got to come back to its mean in subsequent years, you would assume. So election years themselves, while more volatile, they tend to be positive, as we mentioned earlier. Post-election years have an average return of 6.5%. And the second year of the term, often viewed as the weakest, still has an average return of 4%. Now, this makes sense. So if the S&P 500 is an average rate of return, depending on the time period, of anywhere from say 8 to 10%, then if you get an average return of 16% pre-election year, then you have to have post-election years that are lower, right? Just to bring it back towards its mean or towards its average. So what should investors do during volatile times? Well, the first piece of advice is to stay calm. Avoid making knee-jerk reactions based on election news, especially right now, with everything going on and the rapidity of information coming out on X or on whatever app you're looking at or news source you're looking at. It's just flying out there so fast. A lot of it's not even validated or substantiated when it's reported. You got to remember, markets are forward-looking, and they often price in these political changes well before they happen. So like in 2020, despite the COVID-19 pandemic and the very, very contentious presidential election, the S&P actually finished the year up over 16%. So this highlights the importance of staying the course and not letting short-term events dictate your long-term strategy. It doesn't mean you don't call me and ask questions. It doesn't mean you don't have concerns or are worried. It just means that for the most part, we're going to have to stay the course. That's the best course of action. Another strategy to focus on is diversification. By spreading investments across different asset classes and sectors, you can mitigate the risks associated with any single political event. Consider post-election 2000, where the S&P 500 had 3 very negative years in a row. I remember this. I was young, but I was in the business a couple of years at this time. It was negative 10% S&P in 2000, negative 13 in 2001, and negative 23 in 2002. Gross. I mean, that was disgusting. It was a horrible time to get into this business that I'm in. However, same time period, long government bonds, think the Ibbotson Long Bond Index, returned 21%, 3 and 18% respectively over those 3 years. And U.S. small value stocks, using from a French research index, returned 24% in 2000, 23% in 2001, before finally succumbing to a negative 9 in 2002. So a diversified portfolio really smoothed out those years for investors. So let's also consider the importance of fundamental analysis during election years. Companies with strong balance sheets, consistent earnings growth, and solid management teams are likely to weather political changes better than those with weaker fundamentals. Take a look at companies that have shown resilience and adaptability in the past. It's crucial to have a well-defined investment plan and stick to it. So all of you who are clients of mine, we have an investment policy statement. All of you do. And we stick to that. That is our roadmap. This includes setting clear financial goals, risk tolerance levels, and time horizons. Having a plan in place helps you stay focused. It helps you avoid making impulsive decisions based on market noise. During the 2000 election, for instance, the uncertainty surrounding the Bush-Gore recount led to severe market volatility. I mean, there were a financial situation, recession, and eventually we had 9/11, obviously, in 2021. But that Bush-Gore was the kickoff to a very difficult 3-year time period in the market. But investors who stayed the course and focused on their long-term plans ultimately benefited as the markets recovered, especially when they had that diversification play in place. Now, you can't forget, obviously, about the psychological aspect of investing during election years. It's easy to get caught up in the headlines, especially now, and let fear or greed drive your decisions. But behavioral finance studies have shown that emotions can lead to poor investment choices, such as selling at market lows or buying at peaks. One way to combat this is to practice mindfulness and stay disciplined. I'll repeat this. I said this last week too. Warren Buffett's quote, "Be fearful when others are greedy, and greedy when others are fearful." Now, this is especially going to apply in 2024 election, I'm certain. Finally, let's look at some historical examples to reinforce the points we've already made. During the 1980 election, Ronald Reagan's victory initially led to a lot of market uncertainty. Remember, he was an actor. Yes, he was a governor of California. Yes, he had a political career, but people did not take him seriously, and the S&P 500 ended up gaining 25% in 1981 as his economic policies became clear. And then in 1992, Bill Clinton, his win caused some initial market jitters too. Young guy, untested, governor of Arkansas. But once in office, the S&P saw a 7.6% gain that year and continued to perform well throughout his presidency. So while looking at these presidential election years, while looking at the data and the information and all the noise, it can bring a severe level of uncertainty and a lot of volatility. All of the historical data shows that markets tend to trend positively over the long term. Stay calm, diversify your portfolio, focus on the fundamentals, stick to your investment policy statement, manage your emotions. Let me worry for you. You can navigate these periods successfully. Let everyone else panic. Remember, investing is a marathon. It is not a sprint. We're going to get you to the end zone. Stick with us. Now for the fancy compliance talk. Registered Representative Financial Advisor, Park Avenue Securities, LLC, Pass, OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through Pass, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners is not an affiliate or subsidiary of Pass or Guardian Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. California Insurance License Number OD34103. This podcast is for informational purposes only and not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Pass, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or to make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. Diversification does not guarantee profit or protect against market loss. Investing in the bond market is subject to certain risks, including market interest rates, issuer credit, and inflation risks. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. 2024-178115 expires July 2026.